Phone Financial Phil McCoy from Ameriprise Financial and the Mirius Group of Financial Advisors. Good morning, Philip.
Good morning, guys. How are you all?
We are well, sir. How are you?
Living the dream, Rob.
It's a big week for NVIDIA, Phil. As earnings reports go, this is as big as it gets.
Yes, it is. It's as big. It's not just a big week for NVIDIA. It's a big week for the tech market as a whole. NVIDIA has been responsible for the last few legs of our bull market run. So whenever they report or good news comes out about NVIDIA, it seems as if all the tech companies, or most of the tech companies, follow suit, and we take off yet again and start talking about the top-heavy markets with technology and chips. And then there's a rotation like what we had seen some of last month, where the Dow kind of caught up, if you will, with the NASDAQ and S&P, and then take off yet again. So, but we need that evidence in this earnings report. And it's not going to be just the earnings and what those numbers look like, but it will be the forward-looking guidance from the CEO and the words that they have to say. So probably the most important earnings that we'll get this earnings season is NVIDIA this Wednesday.
And they have set a standard that as a company grows, we've seen, Phil, from these tech companies that were small at one point and then shortly thereafter were huge, it becomes more and more difficult to impress Wall Street with your earnings beats.
Yeah, eventually you can't catch up, and you can't keep up with your own expectations. Look at maybe Apple as a good example of that, and Amazon as a decent example of that, where at every opportunity, at one point those stocks absolutely took off, but it was hard to keep up with their own bar that they had set, so they couldn't cross their own bar. And eventually, I imagine we'll get there with NVIDIA too. I don't know if we're there yet, but eventually we'll get there, and then there'll be a more slow-growing company opposed to what they have been.
Mr. Stubblefield.
Good morning, Phil.
Good morning.
This last week, the Russell 2000 small cap companies were up close to 4%, following the Jackson Hole meeting with the Fed. However, that's contrasted with a large cap, which was up only 1.5, less than half of that. What's the difference between the large and small cap and their response to the Jackson Hole meeting?
Bill, that is a great question. And small caps we don't talk a lot about. And the small companies, and that's what that means, small capitalization, the smaller companies. And look, we're not talking about mom and pop shops on the corner. They're still big companies. But in terms of what's on indices, the small companies have yet to recover fully, or to the extent that the large companies have, from the initial rate increases back in 2022. If you remember the 0.75 of a point rate increases, it really hit those hard. And the reason being is rate cuts. That's why the markets are so drawn in to what the Federal Reserve has to say in regards to rate cuts, is all companies want rates to come down. Make no mistake about it. All companies rely or use borrowed money to some extent. But the smaller companies rely on that more. And so, therefore, they will prosper more when we're certain that rates are going to come down, simply because in a lot of cases they have no choice. If we're going to expand, if we're going to meet payroll, it's going to be done on borrowed money. And large companies, in like the case if you think of the Apples and NVIDIAs, in most cases they have the cash on hand to do that if it's not a good rate environment for them to borrow money. So what we had seen on Friday, and small caps have been very volatile through all this. If you just look at the odds, and it's not on a bet MGM or anything, but the odds of a rate cut in September, they had started August up around 90% that there's going to be a rate cut. And then we got a PPI report that underwhelmed, and those odds dropped to 40%. And our markets gave a lot of their growth back, especially small caps. And then after Jackson Hole, the signal was, and I really didn't get the same feeling, quite honestly, when I listened to him. I didn't get the same feeling that the markets got, but our market saw that as a hugely positive, dovish move from the words coming from Jerome Powell. And now the odds are back up to 89 or 90% of a rate cut in mid-September. But because the smaller companies rely on borrowed capital more, Therefore, they prospered more when the certainty of a rate cut is increased. So it was a good point that you make there, Bill, because a lot of us, we don't talk about the small companies. In a lot of cases, they're regional, or maybe we don't see them on our food or in the stores when we go to buy clothing or buy our vehicles. But those small companies sometimes are the tail that wags the dog, and that was in our 401ks and our investment portfolios, because you should have some exposure to it. And that's what we saw on Friday. So some of those assets that have struggled, hopefully you still had them and didn't cut them out when they struggled to regain their value. But Friday was a great day for small caps. And to see an indice with that many companies go up 4%, almost 4%, that's pretty impressive.
Mr. Gilstrap.
Well, we see those advantages come in even a small company like a radio station here, where I'm just noticing that the clock that has been dead for weeks now, finally, we're able to afford new batteries.
No, that was from private donation.
Was that from private donation?
Yeah,
okay, that was not a.
We have a wealthy donor who funded the battery swap out of that.
Oh, okay.
I don't want to point to anybody, but
right.
he's sitting
But
at
I'll
this
take
table.
full credit, Rob.
Hey, listen, some news broke last week or over the weekend maybe, that I actually thought was sort of startling. And maybe it's been going on forever and it's just making news now. And I know you don't like to talk politics, but maybe this isn't political. But Uncle Sam took a 10% share of Intel, which gives the government a seat on the board. And I find this oddly unsettling. I mean, not that the government hasn't always kind of had a seat on Northrop Grumman's board sort of by default because it's a government contractor, but is this unusual, and are there ramifications to it?
It is and it isn't. So it's not unusual that the government take an equity stake. And as my understanding, I don't think these are voting shares. It's my understanding. I could be wrong about that. But it's not unusual that the government take an equity stake in a American company. That's not unusual. What is unusual in this case, it wasn't done by bailout, and it wasn't done by Intel reaching out saying, "Hey, help me." The money that they got for this 9.9 or 10% shares was supposed to be coming to them by bills anyway. There was a CHIPS Act, and I just forgot the name of the other bill, but there are two bills that would have totaled giving Intel the money for the stock equity in Intel. So now the U.S. government is close to a 10% shareholder, and there's a lot of different opinions coming out on this. Rand Paul is not happy at all about this. He called it socialism in a sense. But after the news, the stock shot up quite a bit. It was up 5-6%, if my recollection of last week, when it was confirmed that the government does now hold 10%. Now, the headline said U.S. government didn't pay anything for this 10% equity stake, and that's true and untrue. It's true by way of that money was coming to Intel, or supposed to come to Intel anyway. So that was coming anyway. So that part of it is true. But they did receive funds from the U.S. government for this 10% holding. Now, as far as how investors are looking at this, and a lot of them are looking at it as, hey, they're going to get preferential treatment. The government will now use its influence with companies to help Intel get customers. And that's what Intel needs. So if you say, well, why did Intel just essentially give 10% of its company to the U.S. government? Why would they do that? Well, the thinking is, well, if the government owns 10% of our company, whether they're voting shares or not, it's irrelevant. If the government owns 10% of our company, then therefore they may use their influence to encourage others to buy our product. And that's what Intel has struggled with. Intel is a chip maker, but it has trailed the likes of NVIDIA and some of the other chip makers and struggled in keeping up with that. So now the perception is from those bullish on Intel is that the U.S. government will use its influence to encourage others, maybe by tax breaks, maybe by help with tariffs and the like, that now they will purchase the Intel chips, even if maybe they're not the best, but they will purchase those Intel chips. So it is unprecedented by way of like, well, why did they do this? Because Intel wasn't necessarily in trouble. Intel has been trailing, but as far as too big to fail, Intel kind of fits that bill. they weren't failing. They weren't filing for bankruptcy, so it wasn't a bailout, and the money was coming to them anyway. So why just the gift of 10% equity stake in Intel? And the reasoning behind it would be that maybe a little nepotism could be used in some influence in other companies purchasing our product.
But Phil, so much is in the optics. Just a few days before, the president had called the CEO, asked for his resignation, said he was incompetent, he could not be trusted. And yet, about 3 or 4 days after that, the CEO came in and made this offer, or at least when the president made the offer to Tan, Tan immediately said he'd accept it. Again, the optics of that. Was he being forced into this arrangement?
Remember, Phil is an investment counselor. He is not here
not
to
a
discuss
politician. Okay,
geopolitics.
So. I'll ask that question myself then. So it is optics.
Do we still have Phil, or did Phil hear that question and just run for the hills? I think we lost Phil. Yeah, Phil. I heard a noise click in the background, but I don't know if that meant that you're talking and we can't hear you, or what happened there.
Well, what about John? I'll ask you that question.
Well, actually, I'll answer a different question was in my head. Kind of goes along the same lines. You know, having come from a government contracting background years ago, it's all built on competitive bidding, and when you have as heavy a thumb on the scale as Uncle Sam is going to make money off of this contract, that really throws everything off balance. This is just strange to me.
Phil's back, by the way. It also leads to the purchasing of inferior technology to satisfy a government need, right? So you remember BlackBerries?
Mm-hmm.
Government people were still using BlackBerries 2-3 years after nobody was using BlackBerries in the private sector. Why? Because the government bought a bunch of BlackBerries from people who worked in government. And you have Intel, which is not regarded as the best chip. It's not a chip that's going to wreck your business. Don't get me wrong. I'm not disparaging Intel. But when you read technology magazines or listen to those who are in that sector, Intel was an issue business-wise for a reason. If the government props up the business by buying a bunch of chips that aren't the latest and greatest chips, you're just continuing to feed into the inferiority and ineffectiveness of government, because you're going to be buying chips for computers that maybe could be better served by buying them somewhere else.
And there's another aspect to this as well. I'm glad Phil's back. It's $9 billion of grants that was converted into 10% holdings of Intel. Were there grant money that was normally grant monies do not expect to be reimbursed? They're just money that's given as opposed to loan. So in this case, it may have been money already being given to Intel, and now the U.S. is asking for it to become equity in their stock. Bonds.
And that's what makes it different from the bailout money, Bill, is the gift of, or the giving of what I would assume is treasury stock that was already owned by Intel internally. So that grant money was coming regardless. So goes back to, why would they do this? Why would Intel agree to do this, give up 10% of their own? And it kind of takes me back to Shark Tank a little bit. I don't know if you guys have ever watched that show. I've always enjoyed it. But when what those people with the products are looking for, it's not necessarily the money. It's the influence from one of the sharks that they're really, really looking for, the influence and the knowledge and the ability to push purchases their way, push manufacturing their way, and that's what they're really looking for. And in this case, it's kind of what it reminds me of, is Intel is looking for the assistance of the government down the road, whether it be with contracts from the government or influence to other companies in order to purchase their wares or their chips in this case. So it is different. It's the same. It's happened before, but it is different because looking for a reason. And, Rob, I was listening. I don't know what happened to my phone there. I apologize for that. But I was listening to you, and you sounded exactly like Rand Paul. And I know you probably didn't listen to him, but those were all the same concerns that he had. And he flat out said to him, this was socialism. This was the government taking over a company in order to keep it afloat, or we'll give you preferred treatment if you give us some of your ownership. and he was very, very upset about this move. But from the stock market standpoint, it did give it a boost. You know, it did contribute to quite the boost from Intel. And I think in overnight trading, Intel's done fairly well too, because the perception would be is now they're not going to fail. Now they do have a kind of an ace in the hole as it pertains to competition against other chip makers.
Phil, how is this different from the NVIDIA that we had a couple of weeks ago?
NVIDIA didn't give up any of their ownership. So NVIDIA just agreed, I think, to start to make their product here in the United States more if they could avoid some tariffs. So there was a deal made that, hey, if you start, and we've seen a lot of that. We have seen a ton of that. I think Hyundai is a company that kind of did the same thing, where they get better treatment by way of tariffs if they start to build facilities and employ American workers and put some facilities on American ground.
Phil, I'm looking at Intel's chart right now. It gained 5.5% at Friday's business trading, and then over the weekend it picked up about another 2%. Looking at their 5-year chart, Intel stock peaked above $60 in 2021, and it looks like it was up around close to 70, maybe 66, 67. And then before it had its 5% bump, it was under $20. So it was clearly a struggling company. It needed some type of boost, and it's going to get it. That explains their increase in stock price. And you mentioned in the bailouts, which we've seen with General Motors, for instance, and I remember General Motors stock, it did nothing for quite some time, and then when the government sold it at a loss, and a pretty big loss too. It wasn't even close. I would assume that we'll do better on Intel with the way this is set up than the government did on GM. Do you have any idea why the government had to sell its GM stock at a loss, and why it couldn't hold until the stock price rose to at least equal what it was purchased for?
My understanding from back then, it was GM buying their stock back. And so there was an agreement made with GM that, hey, or with all the bailout companies, that we'll give you a hand, we'll give you money to get through this, but you have to pay us back. And the way that they paid them back was by their stock back, by their treasury stock back. There's no agreement like this in place for Intel. So that would have been why I think the government decided to sell the stock at a loss back to GM, is to just get it off their books and get some money back. But there's, as to my knowledge, there's nothing like this in place for Intel.
It was a double working of the taxpayer, because you're giving money to GM to help them not go bankrupt, and then you can't even get the money back that you gave because you sold the stock at a loss, and a tremendous loss.
Yeah, those are a lot of those companies, and I don't recall, because that was quite some time ago. I don't recall which company stocks did better and which company stocks did worse when they were sold back. My guess would be that the majority of them were lower than what the government bought them at.
So there was a financial piece this morning that America in the Morning ran, and it was a quote, I believe, from somebody with CNBC on their TV show, and it was talking about Jerome Powell and interest rates. And it goes back to what you said at the beginning of this interview 20 minutes ago, Phil, and that is you're not really sure why the market reacted the way it reacted, because you could, and this person said this, easily make a case for a rate increase from what the data Jerome Powell was talking about. So why did the market treat it as a surefire bet that there would be a rate cut when it sounded like Powell was actually saying that there is a possibility there could be a rate increase?
Yeah, and to me, when I listened to, and I didn't listen to it from very start to beginning, I have to acknowledge that, but from what I heard, the key points of it, I did not close out that program and think, oh boy, he's cutting rates for sure, or they are cutting rates for sure in September. That wasn't what I gathered from that. There's two reasons that you could cut rates, and I mean maybe oversimplified. One is a good reason. Inflation is down to its target. That would be a good reason. That would encourage the Federal Reserve to cut rates. And now there's a bad reason. And what he reflected on was the bad reason, which is the unemployment numbers are starting to get worse, and they need to put an end to that. So that is the bad reason that you would cut rates. Think back to COVID. I always refer back to COVID in April and May of 2020 with those massive rate cuts. The reason for that was the bad reason, the job numbers, and because we sent everyone home. They weren't allowed to work, so the unemployment numbers were astronomical. So that was the reasoning why they cut rates then. But the one he alluded to was the bad reason. I didn't walk away with that same thought that our markets did, not at all. What I walked away with was pretty much the same thought as I had before, is they're unsure. They're unsure what they're going to do. There's three things that you could do. I think one of them is off the table. I don't think they're increasing rates in September. But there's three things that they could do. One is increase rates. Highly doubtful that they do that. The other is leave them the same. And that's kind of what I thought that's what that led me to. If I had to place money, and I don't bet, but if I had to place money based off of his speech, what they were going to do in September, I would have said they were going to leave it the same again. And then, of course, third is to cut rates. And our markets feel strongly that what he said was we're cutting rates in September. He's open to cutting rates in September. He suggested that a policy change may be necessary. He didn't say that it was necessary. He said it may be necessary. But we read that completely different. And I'm glad we did, because our markets had a stellar day. It saved the week. I remember saying Friday morning, I don't know that the week could be saved. And I think it basically saved the week and put us back to where we were, close to it anyway, on Monday morning. So I'm glad that I misread that. But that wasn't what I took from it.
All right, Phil, you can get to put your financial planner hat on now, and let's just take a generic person, let's say 35 years old, getting a job where they could have to make a decision on how to break up their 401k contributions. And you've got index funds, you've got bond funds, you've got small caps, international funds. Those are your options. What kind of percentage mix should the average person with typical goals have for those choices?
But in the average person, there's a lot of underlying factors, but I'll just go at, in most cases, you'd see a 35-year-old is a very aggressive investor, probably 90 to 100% equities. But whichever portion of equities that you're holding, in that you would normally see about 30% of it going to large companies. You would see about 15% going to mid-size, 10% going to small cap, and the remaining would be split out amongst alternatives and international as a per dollar basis. But each person is different, so it's not just their financial situation that plays into that. It's their own emotional state, because in some cases, if you can't handle the volatility, even if you're 25, if you can't handle the volatility, it may not be appropriate. You just have to change your retirement goals based off of what you can handle emotionally. But still the biggest piece does go into large companies. By far the biggest piece goes into large companies. Then you spread the remaining out amongst mid-size, small size, and international companies.
Phil, for the last couple so years, the Magnificent Seven, which have been on the artificial intelligence, have had quite a ride. They've taken a small hit recently, and because people have questioned the potential for artificial intelligence. In the scenario that Rob just asked, would you encourage a 35-year-old to invest heavily in artificial intelligence companies?
Yeah, because they kind of fit into, most of those companies aren't just artificial intelligence companies, but those guys fit into the large cap growth portion. When we said large companies, there's a large cap growth and there's a large cap value. And the value is more like the Procter & Gamble's and banks and the likes. And the growth companies today anyway are like the NVIDIAs and the Apples, and if you just look at the NASDAQ. So by proxy, you're going to have a huge exposure to these companies that rely on artificial intelligence, because they kind of all do. When you look at the biggest companies in the world, that's kind of what's driving them right now is artificial intelligence.
Phil,
so just by proxy, you would have a heavy exposure.
How do we reach you today for more information, sir?
You can reach us at 304-263-4343 or stop by and see us with an appointment at 1270 Winchester Avenue, right here in Martinsburg.
Thank you, Phil. Have a great day.
Thank you, guys. Appreciate it.
This is Talk Radio, WNR Martinsburg and TV 10.